Welcome to today's episode. Today, we're traveling back to the fall of 2008, when one of Wall Street's most prestigious investment banks, Lehman Brothers, collapsed overnight, setting off a chain reaction that sent shockwaves through the global economy. How did this happen, and what lessons can we learn from it? Let's break it all down. Lehman Brothers was founded in 1850 as a small cotton trading firm, but over 150 years, it evolved into one of the most powerful investment banks on Wall Street. By the early 2000s, Lehman was at the forefront of the booming real estate market, raking in massive profits. But beneath the surface, a dangerous level of risk was accumulating. In the late 1990s and early 2000s, Wall Street was swept up in the rise of financial derivatives, like mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These products bundled together millions of home loans and sold them to investors, promising high returns. However, many of these loans were subprime mortgages, given to borrowers with poor credit histories. Lehman Brothers was deeply involved in this market, not only buying vast amounts of MBS and CDOs but also leveraging its investments to an extreme degree. At its peak, Lehman had a leverage ratio of 30:1, meaning for every $1 it actually owned, it borrowed $30 to invest. This strategy amplified profits during good times, but made the firm highly vulnerable to downturns. By 2006, the U.S. housing market began to slow, and by 2007, home prices started falling. The flood of subprime mortgage defaults that followed triggered a meltdown in the mortgage-backed securities market. Suddenly, those once safe investments became toxic, wiping billions off the balance sheets of major banks. In March 2008, Bear Stearns collapsed under the weight of its toxic assets, prompting a government-backed bailout by JPMorgan Chase. Lehman Brothers, however, attempted to stay afloat by selling assets and raising capital, but as confidence in the firm evaporated, its stock price plummeted from $86 in early 2007 to under $4 by mid-2008. As the crisis deepened, Lehman scrambled to find a white knight, a financial institution willing to acquire it. Negotiations were held with Bank of America and Barclays, but both deals fell apart. The U.S. government, led by Treasury Secretary Henry Paulson, had bailed out Bear Stearns just months earlier. However, this time, they took a different stance, refusing to intervene. They believed the market should correct itself. On September 15, 2008, Lehman Brothers officially filed for bankruptcy, with over $600 billion in assets, making it the largest corporate failure in U.S. history. Lehman's collapse sent financial markets into a panic. Stock markets crashed, credit markets froze, and banks worldwide struggled to stay solvent. To prevent a total economic collapse, the U.S. government quickly rolled out the $700 billion Troubled Asset Relief Program, TARP, to bail out struggling financial institutions like IG and Citigroup. So, what lessons can we learn from the Lehman Brothers disaster? Excessive leverage is a double-edged sword. It can magnify profits but also massively amplify losses. Markets don't always go up. Many investors assumed housing prices would never fall, leading to reckless risk-taking. Regulation matters. The crisis led to the Dodd-Frank Act, which imposed stricter regulations to prevent future financial meltdowns. Government intervention is a controversial issue. Was letting Lehman fail the right call, or should the government have stepped in? The debate continues to this day. Lehman Brothers' collapse wasn't just a bank failure. It was a turning point in modern finance, a cautionary tale of greed, risk, and regulatory failure. Understanding this event isn't just about history, it's about recognizing warning signs in today's financial markets. Do you think the financial system has learned its lesson, or are we heading toward another crisis? Let us know in the comments. Don't forget to like, subscribe, and turn on notifications for more deep dives into the world of finance and economics. See you next time.